Hello friends, in this video I'll be explaining about financial term investment. This video is created to help beginners to understand what is meaning of investment, why we should invest, and what are the benefits of investment and related information. So let's start with understanding of what is an investment. Investment is a process or an art to save your earning efficiently so you get positive returns in the future. For efficient investment, we need to understand different instruments which can provide you positive returns in expected time period. I'll walk you through different types of investment later in this video, but before that, let's understand more about investment. So investment must not be taken as a gambling or speculation. It's a recurring process where you have to identify the value in the business and then you keep invested for longer duration of time and increase your investment amount regularly in that business. For example, if you think power sector in India is going to be the next sector which will grow rapidly, then as a part of investment exercise we need to find power sector related companies which has good growth capability and start saving portion of your earned amount into that company for longer duration of time with recurring investment. So we need to build some strategy after analysis, like I'll be investing 2000 rupees every month in Tata Power stock for next 3 years of time. So now we have learned what is an investment. Let's try to understand why we should invest. There is a famous quote from Warren Buffett. I hope you all know about Warren Buffett. He is considered to be the most successful investor of this era. As per him, if you don't find a way to make money when you are at sleep or when you are at rest, you have to work till you die. So in a nutshell, if you do not accumulate any amount for future expenses, then you have to work forever till you live. So now let's try to understand few reasons for why any person should start investment as early as possible. I have highlighted key reasons with green text here. We will visit one by one. Let's start with goals. So let's say you have a dream for a big house at a younger age. To make that happen, you have to start investing. Other reason is to save on income taxes. You can save on income tax by saving in mutual funds, which is win-win situation for individual and government. Individual need not to pay taxes on amount invested in tax-saver mutual funds for 1.5 lakh per annum, which comes in the 80C bracket. So that could be one of the motivation factor for the investment. Financial backup is also one of the key reasons to invest, because when you are not going to earn in future, you need strong backup to survive. Inflation, which is increasing day by day, you have to invest to make sure you are able to beat the inflation with returns you earn from the investment. You need to invest to create emergency corpus which you may need in bad times. By proper investing, you achieve financial freedom, which brings better life, and you can work on interest area rather than doing a boring job. Other key reason is to generate a wealth for future generation by investing right and keep yourself invested for longer duration of time. Now we understand why we need to prioritize investment. Let's discuss what are the different types of investment. So at large, it divides into the fixed return investment and variable return investments. Let's try to understand few fixed return types of investment. So investing into the bank's fixed deposit or personal provident fund account, Sukanya Samruddhi Yojana, and other government bonds where rate of interest are fixed. Or if you are employee of any organization, you can avail benefit of investment via provident funds or VPF, which is voluntary provident fund investment, where rate of interest per year is fixed. This kind of investment are also called debt investment, where we can predict the returns which we are going to earn from investment in future. There are other hybrid kind of investment like gold souvenir bond scheme from government, which brings 2.5% of fixed interest income plus the appreciation of gold when you are going to sell at the later future date. It's also safe investment, as you are not investing in physical gold, you are investing in the electronic form of gold unit. Other type of investment is a variable return investment. For example, investment in property, investment in land. Mutual fund investments are also variable in nature when it comes to the returns on the invested amount. Other main area is via stock market, which allows you to invest in exchange registered companies via stock purchase for those companies. Growth and value of the company and its product bring stock price higher, which is considered as main benefit of that investment. Some other investment options are to invest in some private business by purchasing private equity stake in that company. You can also invest in currency and commodity movements via stock market instruments. All of these variable return instruments have higher risk as there is more volatility in this instrument, but it also provides open-ended growth opportunity if you manage to invest in correct company. For example, longer duration of investment in any good company can bring multiple returns, which is not possible in fixed return investment instruments. If you consider stock price of Pidilite company, which offers a famous paint products plus the brand like Fevicol, this stock was rupees 8 a unit in the 2001. Now it grown to 2,700 rupees per stock unit in 2022, which brings around 345 times returns on the amount invested in this stock. So this kind of return we can never achieve via that investment because they only offer a fixed return. Now, as we understood pros and cons of fixed return investment and variable return investment, let's try to understand the last topic of this video, which is diversification in an investment. Diversification simply means to diversify your investment in different types of instruments so that risk of one instrument does not affect your whole savings. If you invest in only one type of instrument, then there is always high risk in return, as what if that investment doesn't work out for you. Let's say you have put all money in property, but due to some regional issue, what if it doesn't bring a positive return, or it brings a less return than you expected? Then your whole amount invested is at risk. So to be safe from those risks, it is always better to diversify investment in different sector of investment types, like some fixed return investment and some variable returns. So as shown in the pie chart here, classic example of diversification where we are suggesting to invest in different instrument types, like you invest some amount in property, some amount in fixed deposit, stock market equities, and hybrid investment type like gold bonds. This way we average risk of negative return and create a balanced financial portfolio. That's all about investment today.